Hey guys, hope everybody's doing well today. I'm going back a little bit. This is a little bit nostalgic for me. Okay, almost a year ago, I reviewed an ETF that is PEY, which is the Invesco High Yield Equity Dividends Achievers ETF. Now, when I say nostalgic, it's because I did it a year ago, and this review is really kind of what catapulted my channel into getting into growth and really catapulted me into doing ETF reviews for the most part. Now, if you look here, let's just go into it here. If you look here, you'll see April 2020. Now, I did title this, it was a clickbait kind of thing back in April, where I put SPHD, should you sell it? Is there an alternative? And I had my little Bitmoji there, smashing SPHD with a guitar. But you can see that this thing gave me almost 16,000 views, and I've never been able to duplicate that again. But it did kind of catapult me into monetization and growing, right? So we're going to revisit PEY today, and we'll see what it looks like today, how it's performed, and do I still think it's a better alternative to SPHD? So let's dig in, but first, like, share, subscribe, do all that good stuff. Down in the pinned comment down below is all the ways that you can support the channel. If you're a regular shopper on Amazon, you can click that link and you can go shop, buy whatever you normally would buy, but as long as you click that link, Amazon sends me a small commission on qualified purchases at no extra cost to you. So that's a good deal right there. So what are we going to look at? We're looking at PEY. It's the Invesco High Yield Equity Dividend Achievers ETF. Once again, it is a mid-value equity ETF. It has almost $795 million in assets, so it's small. Has a 30-day yield of 4.2%, and the expense ratio is high, so it's 0.52 on the expense ratio. This ETF does pay monthly, and since it's monthly, it must be better, right? I'm kidding. But it does have a B rating from FactSet, 5-star rating from Morningstar. Now let's go through here and look at the portfolio composition like I normally do. And we'll talk about this. I'm going to flip back and forth on a couple of screens here, but this ETF seeks to track the investment results of the NASDAQ US Dividend Achievers 50 Index. Okay. Now, what is that? The NASDAQ index, the underlying index, is a index that follows companies that have consistent record of dividend increases, principally on the basis of dividend yield and consistent growth in dividends. Okay. Now, this is called the DAA index. And this is comprised of the top 50 securities. I'm sorry, this is called the DAY index, but the one that PEY follows. And this is comprised of the top 50 securities of the DAA index, which is the NASDAQ Broad Dividend Achievers Index, which includes about 260 some odd individual stocks. So they pick out the top 50 of those by dividend yield from that larger index, and they created the 50. Okay. So you'll see here, does it say how many is in here? It doesn't, but the NASDAQ Achievers Index is comprised of U.S. accepted securities with at least 10 consecutive years of increasing annual regular dividend payments. Okay. So let's look at what makes it up, right? So we'll look at, it's got 51 holdings. It has 50 long and 1 short. I'm imagining that 1 short is cash. So the top 10 represents 32.41%, and the other 40 brings up the rear at 67.59%, and it's all in North America, which is all in United States. So we look at the market cap, mid cap. This is a nice blended ETF, 33% in mid cap, 31% in large cap, 30% in small cap, and 5.5% in micro cap. And Morningstar rates this as a mid cap value fund. If we look at the top 10 holdings, we got Exxon Mobil with 5% of the fund, OK, which is a energy fund, 4.42, Altria Group 3.5, People's United Financial 3%, UVV, I'm not sure what that is. I think that's another tobacco company, if I'm not mistaken, 2.88, Northwest Bank Shares 2.77, Comerica 2.75, AT&T 2.7, Mercury General 2.6, Philip Morris 2.6. So right away you figured out that a lot of financials in here and a lot of energy in this fund. And we'll look at the sector exposure, and just as I thought, financials, 27.7% in this fund is financials, utilities at 19%, consumer staples at 16.7%, energy at 12%, communication services at 8%, industrials at 5%, materials at 4%, consumer discretionary at 3.7%, infotech at 1.9%, and healthcare at 1.2%. The one that it is missing is real estate. It cannot, in the prospectus there, you cannot have master limited partnerships or REITs. So we'll look at the key stats, which I like to do. And we'll see price to earnings, 16.37. So this is really a value fund, and it probably is why it has performed so well here recently. The rotation into value has happened, and if you look at, where we go, if we look back at financials have been, on fire. Energy has been on fire. Consumer staples have been on fire. Utilities, so we can see where the performance has come from. Now we'll go back to that key stats. Price to sales of 1, that's a nice thing to see. But when you come down here, here's where it gets a little funny. Historical earnings growth, 6.61%, not bad. Sales growth though, minus, it's a negative 1%. Cash flow growth is a little bit under 1%. And book value growth is plus 2%. So there's not a whole lot of growth in the companies that are in here, because for the most part, if a company is going to pay a dividend long term, has been paying a dividend long term, and has been growing it, usually they're established, slow growth, higher cash flow type companies that return value to investors, but not a whole bunch of growth here. So one thing I wanted to look at though is look at this portfolio composition. Now this index, let's see if it says it down here. The index securities, this is where I'm a little concerned here. The index securities are evaluated annually in March, so it should be happening here shortly. The above criteria are applied using market data through the end of December. The securities are ranked descending based on their trailing 12-month dividend yield as of the last trading day in February. So what I'm thinking is going to happen is that Exxon Mobil, who has contributed quite a bit to this fund's performance, is probably not going to be there. And why do I say that? Well, if we look at Exxon Mobil, We look at their dividend history. Now remember what this index tracks. You need to have 10 consecutive years of increasing dividend payments. Could be calendar years, fiscal years. But if we look at ExxonMobil, we can see in 2019 they increased their dividend from 82 cents to 87, but they did not raise it in 2020. So based on that, and based on the rules of the index, I do expect them to rotate ExxonMobil out of the fund. Now, and probably OKE too. I didn't even check on that one. But, it's something to keep an eye on, see what they replace it with when they do the rebalance. But I like PEY. I've always have. It gets a bad rap because of its high expense ratio of 0.52. It gets a bad rap because it doesn't have a whole lot of technology. There's not going to be a bunch of growth, but it's a good. If you needed just to pick one value ETF that's going to give you high yield, instead of picking and choosing, a bunch of stocks, you could buy this ETF. It's trading at about $20.41, which is really it's at its peak at the moment, but it's still a value. And you're going to get exposure to all these companies, all 50 companies that have increased their dividends for at least 10 years. So that's what I like about it. Now, if we look over here at the dividend growth of PEY, you'll see that PEY, I don't think it's been around for 10 years, so I don't know where they're getting that. But a 5-year dividend growth rate of 9.34%. It's not too bad. 7.47% in 3-year and 8.57% in the 1 year. So not too shabby. And if we look at the dividend history, and we'll look at the chart, we'll see it kind of dipped there in 2020, but it looks like it's going to head up from here. So good thing to look at. So how did it do against SPHD, right? The PEY is like the redheaded stepchild of SPHD, right? And they're kind of similar, very similar in my opinion, as far as what they're trying to achieve, right? SPHD is just straight yield. PEY, at least they have that little bit of thing with increasing dividends, right? I don't know, I was lost for words there, but they have that increasing dividends of 10 years requirement to be in the index. So that's a good thing. So how did it do? Well, I'll go to my ETF channel website here, and we'll punch in the growth, and we'll look. PEY is in blue, and since one of these inceptions of 10/26/2012 to March 11th 2021, PEY has returned a total return of 190.49% for an average annual return of 13.57%, versus SPHD's total return of 131.63%, or an average annual total return of 10.55. So how did PEY do it, right? And why isn't it more popular? I don't understand. I think the SPHD, I don't know, it has more of a cult following for some reason, but I think PEY, with its 10 years of dividend increases requirement to be in the index, is a stronger, and I've always thought it to be a stronger ETF, just based on the requirements of just that, right? So I'd love to hear your thoughts. Thanks for being here, celebrating this little milestone of 1 year of when this last video that I looked at PEY came out. If you got any comments, leave them down below. Like, share, subscribe. We're growing. we're about to hit 3,000 subscribers here. I'm hoping to do it by the end of March. Let's see if we can get that done. If you can like, share, subscribe, and do all that, I think we could, and I'd appreciate it. So leave me a comment down below. I'll talk to you later. You guys have a great weekend. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.